We're talking volatility today, so let's get right into what causes market volatility.
Well, a lot of things can cause market volatility, but two of the really common ones are geopolitical events like war, terrorism, elections. Markets don't like uncertainty.
And that's not about to change anytime.
It hasn't changed for the last however many millennia, so it's probably not going to change in the immediate future, no.
Right. So, but given volatility, how should we invest?
Well, I think it's about accepting, first of all, that volatility is always going to be there, and then deciding, do you want to be a trader or an investor? And if you want to be a long-term investor, then you need to be in it for the long term. And a lot of people hate hearing that. They get sick of financial advisors saying, stay for the long term, stay for the long term. But I look back, it's October, so I look to 1962. October 1962, the Cuban Missile Crisis. Right? The uncertainty at that point was whether or not the Soviet Union and the USA would launch nuclear weapons at each other. Right? Was the world going to come to an end? And then we had Vietnam, we had impeachment for Nixon, we had stagflation, we had the 1987 market crash, we had the financial crisis. And yet, despite all that uncertainty, all that volatility that we've had, the Dow was at 600 back in 1962. Today, it's at like 26,000. So to me, the statistical record is that over time, markets head higher and investors do well, but they need to have that discipline to stay the course.
Staying the course, though, that's hard to do, though, sometimes, especially when it's your retirement nest egg.
It really is. I mean, it's by no means easy. And I think one of the things to do in order to help stay the course is make sure you have the proper portfolio to begin with. And of course, everybody's version of a proper portfolio is going to be different. But what you don't want to do is get overly excited by recent market events, right? We're in this great bull market where stocks have gone up for 10 years or whatever, for the most part, in a steady upward rise. And then it's, okay, great, let me buy more stocks. I want what's done the best. That's the worst thing to do. You need to keep your discipline and have a portfolio that's going to last you, not just during good times, but during bad times too.
So sometimes people think they can beat the market by getting in and out, or they can pick the best securities. And even money managers trying to pick the best securities, they don't always have the best track record.
That's true. And so let me ask you a question. You've got an IRA and a 401k, and I'm hoping based on a lot of what you say, you have a Roth. Would you take that Roth to Las Vegas and put it on the roulette wheel or the blackjack table?
Not likely.
No, not likely, and I'm glad to hear you say that, or I'd be really worried, right? So your odds of winning, depending on the casino, at blackjack are something like 48%, roulette's like 45%, and slot machines are like 35%. So people don't invest in that because you expect to not succeed. Well, if you look at the average active stock picker, they haven't succeeded. In fact, less than 1 in 5 historically have done their job of outperforming the index. That doesn't mean it's impossible, but it means it's really, really difficult to do.
When it comes to stocks, there's different kinds of stocks. They have different characteristics. So can you address, like, certain stocks tend to have higher performance than others?
Yeah, and so I think instead of trying to buy the best stocks, which involves looking to try and see the future, right? Instead, what you can do is try to buy the best kinds of stocks. So instead of individual stocks, the best types. And those characteristics are things that a lot of people call factors, which academics have found. And these are people far smarter than me. Some of them have won Nobel Prizes. And they went out and they did a lot of research and they analyzed all of the stocks that have ever traded, both in the US and in all these other countries, the UK, Australia, and so on. And what they found is that certain kinds of companies do better, certain kinds of stocks do better. And in particular, value companies, value stocks tend to do better than growth stocks. Small companies tend to do better than large stocks. And then finally, more profitable companies do better than less profitable companies. And so the idea is that in building a portfolio, you overweight those securities that historically have done better. And of course, that's no guarantee. Right? It doesn't mean that this is going to do better all the time. Recently, over the last couple of years, growth stocks have done better than value stocks. Small companies have done pretty well, but the value part that historically has been so great has not performed that well. But if you look over the long-term track record, these companies expect to do a little bit better. And by having securities in your portfolio with higher expected returns, what you can do is you can own less stocks. And the reason you want to own less stocks is that allows you to own more safe assets. And that's really investment nirvana, right? Because you can build a portfolio that has the same expected return or a similar expected return, but with a smoother ride. And I think for a lot of people, particularly as they enter into retirement, it's about, hey, I need whatever percentage return on my portfolio based on my financial plan. Then let me get it with the smoothest ride possible so that I can go enjoy my retirement.
So what you're saying is you can be a little bit more aggressive on some of your stock portfolio, which allows you to have actually less invested in the stock market to try to smooth out the ride.
Exactly, and then you fill in the rest with safe assets, maybe a little bit of cash, maybe some high quality bonds, and you remember that you're taking your aggressive position, your growth in your stocks, so you keep your bonds safe. You buy high quality bonds, you buy relatively short maturity bonds because they're less susceptible to interest rate increases, and by pairing those high quality bonds with somewhat more aggressive stocks, you build a portfolio with attractive expected returns, but your ride is smoother than if you just piled all of your money into, let's say, the S&P 500.
So let's talk about investors that get nervous about we're at all-time highs and they want to get out of the market. What tends to be their experience?
Well, that depends heavily, right? I mean, if they've got a really good crystal ball, their experience is really good. Right? Absent the crystal ball, it tends to be abysmal. And really, they have a couple of challenges. And the first of those is that, like I mentioned, over time, the upward momentum of the market is higher. And so you're swimming across a rising tide. The second part of it is that it's really hard once you get out to know when to get back in. Right? If you think about it, in September of 2008 was a great time to get out of the market when Lehman Brothers went under, but the market bottomed in March of 2009, and how many people had both the foresight and the intestinal fortitude to get back in then? And then the third problem is that when you look at the numbers, a large proportion of the market's gains over time tend to be concentrated in just a handful of days. In fact, if you go back to the late 1980s, it turns out that you would lose more than half of your return by missing out on about 24 of the best days. Exacerbating the problem even further is that most of those best days happen during bad times. They're either during bear markets or recessions or following very sharp market sell-offs, which is just when the market timer is most likely to be out of the market. Missing out on just those couple of days, being only 99% invested instead of 100% invested, cuts your long-term returns in half.
It's virtually impossible to figure out when those days are actually going to happen until they already happen.
Exactly, right? In hindsight, it's always obvious that, 2008 was obviously going to be a bad market because of all the things that went on. But you could have said the same thing in 2011. You showed a chart before of the VIX, and you saw some volatility in 2011 and 12. We had the European Union, fears of that breaking up, and the fiscal cliff in the United States. But it turned out not to be so bad. Even with the most recent presidential election, the common wisdom was that if Trump was elected, markets would fall. And they did fall for about 4 hours. Right? People that subscribed to the common wisdom and got out as soon as things started to decline would have missed out on a tremendous rally since then.
So it sounds like you've got to figure out what kind of portfolio you need. You need to stay invested. Maybe you want to sort of tilt it a little bit to small in value to get a little bit higher return, but maybe have a little bit more safety for a little bit smoother ride.
Yeah, and I think most of these things are things that you do ahead of time, right? Preparation instead of reaction. So you prepare by making sure that your portfolio, your mix of assets, is appropriate to what stage of life you're at and what your financial goals are. Right? And a lot of people forget that. They invest the way that they did 20 years ago, they never change, and all of a sudden they're closer to retirement and they have too much risk in their portfolio. And then you need to rebalance that portfolio to make sure that as one asset class does better than the other, right? We're in a great bull market for stocks. It's important for some people to rein in the percentage of stocks in their portfolio. And then finally, just remember that bear markets, corrections, and the like are part of the normal cycle of capitalism. They do occur, and people that are prepared for them and accept them and have proper portfolios generally wind up okay coming out the other side.
Thank you so much, Brian. That was great information.
Thank you.
And I think our viewers would agree. There's a lot of nuggets of knowledge there that you got to pay attention to.